The tax treatment of private equity firms in Australia is a major headache for the sector and one that could threaten foreign investment. Another is the perception that private equity leaves little or nothing on the table for new investors when exiting a company. That reputation was enhanced by last year's Myer float, which made TPG rich but left investors out of pocket for hundreds of millions of dollars, with shares still wallowing around 20% below the listing price. To discuss this and other issues facing private equity, I spoke earlier with the Managing Director of Harbourvest Partners Asia, Bilden, who's on a visit to Australia from his base in Hong Kong. Bilden, welcome to Lateline Business.
Thank you, Whitney.
An Australian judge recently slammed Australian tax law and how private equity is treated here. What sort of impact does this have on investment decisions?
Well, Australian tax has been one of the stable pillars of investment in this country for foreign investors such as Harbourvest and other pension funds and institutions around the world. For the past decade, there's been remarkable stability and predictability to the tax regime. The recent ATO interpretation of existing code does create some uncertainty for institutional investors about what the future holds for new investment as well as for existing investment. So bottom line, it is a departure from precedent, and we know that the industry is working very closely with government to try to provide some clarification to that. It's very important that that clarification does take place.
So should both capital gains and income be taxed?
Well, for international investors, just to be very clear, there is always tax paid by the jurisdiction in which the investor is domiciled. So as an example, a U.S. taxpayer does not escape capital gains tax. It's just that they are subject to the tax jurisdiction in the United States for an Australian transaction. But what's currently being proposed is that there would be taxation at the actual investment destination in this particular market. And from a competitive advantage, what that will do to Australia is it will make it a less attractive tax destination.
So what's the payoff to Australia if foreign investors aren't paying tax and there's no dividend to the public purse?
Well, it's not as if Australia doesn't get the benefit of any sort of flows from foreign direct investment or from the buyout industry here. In fact, it's very critical that Australia attract those monies because it has a multiplier effect in the economy through the expansion of private businesses and growth equity businesses and just a more rational capital environment. Australian superannuation funds are big investors into the private equity asset class around the globe, in the United States market, in Europe, in other parts of Asia. One of the powers of that model is that they're not taxed in those markets. They would ultimately only be taxed back in Australia, so it creates a fair and level playing field.
The climate for investment seems quite volatile at the moment, so how difficult will it continue to be to get investors on board, and where are the opportunities?
Well, there are plenty of opportunities in Australia, no question about it. So whether it's in the resources-related sector, which some private equity has been devoted to of late, or more focused on the domestic economy, much like other economies, it is viewed as a very attractive segment. A critical ingredient, however, will be the fate of the banking sector and the liquidity that is offered or not offered by banks. Here in Australia, you have 4 very strong banks. They've been the absolute bulwark to financing to the buyout industry. But the international banks were very active in 2006 and 2007. They are much less active, if at all present today, and that will put a constraint on some of the deal activity into 2010 and 11.
So in what sectors are we likely to see the most activity?
You know, it could very well be across the spectrum. It's not necessarily going to be, for example, in resources or resource-related, but that would be an area that would have certain appeal, and valuations probably would reflect that. Private equity generally cuts across multiple sectors of the economy, and that's why it's such a powerful asset class in terms of jobs creation, in terms of a multiplier effect on the economy. And it's one of the reasons why it's very much in the interest of developed economies to promote an active and healthy private equity and indeed a venture capital segment. So it would be pretty broad-based.
At the height of the boom, we saw a lot of disastrous deals and potentially disastrous deals like Qantas. What lessons have been learnt?
hopefully the lessons of over-leverage and discipline on balance sheet structuring. The fact is that not just here in Australia, but in the United States market, in Europe, and in other parts of the region, there was simply too much liquidity, and not just in our asset class. It was in infrastructure, it was in property, and we're seeing on a global basis the ill effects of that. I think many governments have realized that they can't spend more than they create in terms of government revenues, and equally companies are in the same boat. The banking sector is no longer able and simply not capitalized to have the kind of loose lending that took place previously. So many lessons learned in boardrooms, from banks to companies like Qantas, but also by the practitioners of private equity.
So what does this tell us about the type of companies that private equity will go after? Will they tend to be more conservative?
They will definitely be conservative, almost by force. And the scale of investment here, in terms of the enterprise value of the businesses that would be bought by private equity or partnered with private equity, will probably for the next couple of years in Australia be at what I would define as the middle market. And those are typically businesses that are less than $1 billion enterprise value. It's not to say that there wouldn't be possibility above that, but that will require, in all likelihood, a syndication of banks outside of Australia.
A number of floats in Australia have been postponed, and the Myer float was fully priced, so it appears investors are more wary of private equity.
Well, at the moment, I've picked up on that trend here in Australia, but you have to look at the long term. There have been many successful private equity-backed companies in this market where institutions and retail investors have done remarkably well over the long haul, holding the shares of post-IPO companies that were at one point owned by private equity. Our experience across global markets would conclude the same. So it's not to say that there won't be one or two examples where, as you describe it, something might be fully priced. That's probably a reflection of supply and demand of capital at any point in time. But generally, a successful IPO exit leaves something on the table for others to take to the next level.
Philip Bilden, thank you for joining Lateline Business.
It's a pleasure. Thanks very much.